All right, thanks so much, guys. Thanks to the IMAP team and Toby and Jenny for setting up today. As you can see on the screen, my presentation is titled Mispriced in Plain Sight, the case for an allocation to global REITs. My name's Mark Mazzarella and I'm the head of real estate securities at Dexus. We're a diversified Australasian real asset manager with just over $50 billion in assets under management, principally in direct property, so office buildings, retail shopping centres, industrial warehouses, and growth markets, which includes infrastructure. Number of assets that you'll know of, but effectively the part of the business I lead is the real estate securities team within the funds business. We run two principal strategies. Sorry about that. The A-REIT fund, which has been in the market for just over 17 years now. And that's a strategy focused solely on domestic A-REITs, set up to deliver a relatively high level of income. So pleasingly, over the last 17 years, delivered just under 10% CAGR, total return. Most of that, just over half of that, almost 2/3 in income. So it pays a relatively high distribution on a monthly basis. Passive rental receipts pass through to the underlying investor in the funds and, of course, your portfolios. And, of course, on the other end of the barbell, as we like to term it, is the Global REIT Fund. So the Dexus Global REIT Fund first originated almost 10 years ago, but has been in the market, launched 6 years ago, and is just about to come up to its 6 year of track record, and pleasingly has delivered a pretty solid total return there of just on 8%, but most of that return is in capital growth relative to income, which is just under half there. Still an income focus, but given it's invested offshore, relatively lower yields, more of a focus on total return and capital growth as a byproduct of that. Just on our investment philosophy for real estate securities, we're relative value investors focused on growth at a reasonable price. We're fundamental bottom-up investors, so myself and most of my team have a direct property background within real estate investing, private equity, corporate finance, valuation. And of course, a number of analysts in our team have worked across the buy and sell side for many years. So we like to find relative value and invest where it makes the most sense on a risk-adjusted basis. And of course, right now in the market, we see that there's a tremendous opportunity, notwithstanding the volatility and notwithstanding the global ructions. Of course, real estate is a real asset class. You don't trade buildings across borders physically. And a number of the most resilient real estate portfolios are in the listed market, and they serve their local economies and local communities. And we're able to absolutely find opportunities that can keep pace with inflation or indeed exceed it, given the localised supply and demand dynamics, which vary across sector and market. So look, why are the REITs mispriced in plain sight at the moment? We think this has been a constant story and a constant thematic that I've had in presentations to investors, to asset allocators, to those considering an allocation to the sector, to those investors who are perhaps having a look at relative value across their equities portfolios globally and thinking of reallocating some pretty strong returns elsewhere. And basically, we've got a number of green lights and a number of ingredients that are setting up really well for the sector, both from the top down and bottom up. And I guess from the top down, we've got a scenario we have had in most developed markets where interest rate rises are relatively scarce, except for here in Australia, of course. But in most developed markets, indeed outside of here and of course in Japan, rates have essentially been stabilised in the post-COVID normalisation era. So we might have a higher resting heart rate of inflation here in Australia in particular, but definitely a normalised cost of capital as it relates to the real estate investing landscape, certainly in most developed markets, particularly the US, which while they didn't cut rates overnight, certainly closer to doing so than they are hiking. Bottom up, is probably where we're most excited for the sector's prospects, and that's because we're coming out of a period post-COVID where the cost of building or developing anything has just gone through the roof, and it's extremely tough to bring new space online. And if anyone's had the misfortune of doing a home renovation like I have in the last 3 years, you'll know that it costs a heap to build anything. And that's a similar thematic across the built form markets globally. And, you know, it probably might surprise you, it certainly surprised me, but in locations like Japan, economic rents for office buildings are effectively 40% higher than where they are today because of cost inflation and roadblocks to new supply. The only sector that's brought on any supply of note relative to the last few years has been data centres, and there's a chart that goes into that in a bit more detail, but the demand-supply dynamics are some of the most strong that we've seen, particularly in some sectors like seniors living. We've also got a backdrop where, given the normalised cost of capital and, you know, the top-line growth attributes of real estate portfolios, given their earnings are effectively driven by rents that are indexed to inflation or fixed on a per annum basis. And of course, couple that with where we can find as active managers opportunities for demand supply imbalances that can build revenue growth ahead of the system. That's a really powerful growth algorithm for the sector's bottom line when you've got an income statement that has a relatively stable cost of interest. Many of the REITs, indeed most of them, have pretty active treasury teams and a weighted average hedge maturity across their debt books, effectively fixed debt of anywhere between 50% and 100% generally in the main, and they're fixed at relatively attractive levels given the shape of the swap curve as well, most particularly in North America now, because we've seen their curve move a little bit lower as well. So that's interesting in and of itself. We've also got historically wide discounts on the global equities, relative valuation-wise, against the REITs. So on a price to cash flow basis and price to book value basis, the elastic band stretched relatively far, and for a sector that's underpinned by brick and mortar real estate that you can touch and feel, and with really visible earnings growth, it's probably another signal, at least in our view, that the sector's relatively mispriced. And of course, then there's active management, which is, again, the ability of managers such as ourselves to find the best prospects for total return and relative performance from parts of the market that are undercovered by the sell-side analyst cohort. Given the REIT sector is a relatively small one globally and has been lagging global equities, but still putting up the types of returns that you'd expect from a liquid real asset class like this of, 8 to 12% over the last recent period. So, look, in a bit more detail, the macro backdrop for the sector. You can see here on the first chart the cash rate across the developed markets of Europe, the UK and the US. We're through the snake, as my New York-based colleague would suggest, and we're in an environment where the cost of funds is relatively normalised, at least from the perspective of developed central banks and the policy rates that target relatively stable inflation in that range of 2 to 3% everywhere outside of Australia. Is effectively being met. While there will be bumps in the road, I mean, we're going through an energy shock. It's still a pretty solid sector to be able to get access to that if you know where to look and can find those opportunities. And of course, global economic growth. While we're clearly in a stressed type of near-term environment with GDP coming under pressure, there's been a tremendous amount of forward CapEx, particularly in anything related to data centres and technology. And that's effectively driven upgrades in the US GDP outlook, which are illustrated by that maroon part of the first bar chart there. The macro backdrop supportive, effectively at a high level, given inflation's moving back into the box that we can see here on this slide. So going back 30 years, real estate returns from the global REITs tend to perform as you'd expect in that 8 to 12% total return CAGR range when inflation is within the bounds of what's targeted by central banks with their policy actions. And you can see that while we're on the cusp of moving back into that grey box, we're not quite there in the centre where the REITs tend to perform relatively more consistently, but we're not far off, and the direction of travel, while it might be bumpy, is definitely closer to arriving there than it was over the last few years in particular. I mentioned bottom-up fundamentals. Real estate is a relatively simple asset class because you get great visibility to supply and the amount of space that's coming online, so your competitive position as a real estate landlord. And in every sector across the developed markets except data centres, the amount of supply that's been forecast to come online in the coming 12 months is an order of magnitude below the average amount that was brought online over the last 5 years. Of course, that's not the case in data centres, where there is a heap of building, and no doubt there will be overbuilding. That's just how real estate markets work. If there's an opportunity for a developer to make a profit, every developer will take that opportunity. It's just the way it works. It's our job as active managers to get ahead of that and anticipate it coming. And certainly in the case of data centres, we're taking a relatively risk-aware, selective approach to that because the types of numbers being bandied around are extremely high relative to the returns, as one example. Capital formation and transaction activity, really interesting. I can recall back to calendar year 23 when the mantra was stay alive till 25, and here we are in 2026, probably grateful that we are alive, and still waiting for the capital transaction activity to really kick off. And it's been a lot slower than anticipated, but no doubt with the normalisation in the cost of capital and a bit more of an impetus to deploy money, that will ramp up and be the case. So, I mean, over in Europe in particular, there's a fair bit of debt available and deployed to high quality counterparts in the REIT space. Indeed, spreads have come in quite materially. And just last August, one of our investee companies that owns high-quality Paris office buildings issued a 10-year bond at a coupon rate that was around 15 basis points tighter than the French government's own 10-year bond that was issued at around the same time. And that just goes to show the underlying quality of the real estate in these portfolios in spite of the macro backdrop as well. There's genuine momentum in earnings growth, mainly because of the top-line attributes and the dynamic with the middle part of an income statement where the interest costs are relatively stable. We're through the snake of interest rate rises that were incredibly severe and very sharp through 2022 and 23. And now the REITs have got a growth algorithm now that they hadn't had in the past, and that'll allow them to put up some pretty solid earnings. So on our numbers, we've got a weighted average 3-year earnings CAGR in our fund of around that 6 to 7%. And that's amongst the highest it's been since we launched the fund, which is really quite incredible given the backdrop and uncertainty. But it just goes to show the resilience and visibility of the sector's earnings growth. Historical sector discounts to equity. It's really crude, and I can't help but laugh at myself for putting up these charts that compare the dot-com bubble bursting to where we are today and the NASDAQ relative to global REIT performance, because I've been talking to this kind of a dynamic for the last 3 years and been wrong. Indeed, last year was the fourth consecutive calendar year that the global REITs had underperformed global equities. That hadn't happened before in the last 30 years. The only time it was 3 consecutive years was the period leading into the dot-com bubble bursting in the year 2000, 99, 2000. So history, rhymes, all of that kind of thing. Parallels of CapEx, spend and expansion, uncertain return profile, sheer weight of numbers and blind investment to a degree. You can't help but see that it rhymes. And, that's not to say that it will be a mirror image of the dynamics that took place then, but it's just another ingredient or yardstick perhaps to suggest that there is value on offer in the REITs at this stage and at this point in time. We had a similar dynamic to the earlier parts of last year with the DeepSeek announcement, and tech equity sold off quite dramatically. Through that early part of last year, the REITs outperformed quite substantially. And they did again this year as well, earlier when there was some ructions around the software contagion from AI spend and Claude's developments, which led to the software-led tech sell-off. Unfortunately, with everything that's happening in energy markets, that has effectively brought everything down together. But those dynamics and those small little increments of developments do certainly pose an argument to suggest that perhaps where our relative value is attractive and that elastic band is indeed stretched pretty far. And I won't even get onto private credit in that same light, but there's definitely a number of chinks in that armour that are appearing as well that many didn't anticipate. Improving direct and REIT corporate activity, that is very much the precursor to more intense direct asset activity on the investment side and proofing up of private of asset values. And last year, in the second half of the year, we saw a lot of activity there, where the disconnect between fair value and what was priced in the REIT market was just extremely stark, and private equity and indeed other less discounted REITs stepped up to the plate and actually executed some M&A and corporate activity. And thankfully, our fund was on the receiving end of a number of those bids and drove performance as well. There's genuine portfolio diversification benefits in the sector. This chart here shows the correlation going back 10 years in the green bars versus the correlation over the last 6 months only of the REITs relative to the Magnificent Seven. It's never been this strong of a diversifier as a sector in client portfolios. And there's two reasons for that. I would say that many of the other larger equity indices have increasingly got first order and second order relationships and correlations with the tech trade to a much greater extent than they had in the past, purely because of the Magnificent Seven's weight in indices, but also because of the flow-on effects of the tech market and what's driving equity markets generally. I would argue that for client portfolios looking for a diversified, liquid, global real asset class like REITs, and that part of a portfolio, you probably don't want the same level of exposure to tech equities or the Mag 7 from that type of a position in a portfolio. So that's why it's incredibly powerful as a diversifier, and that's indeed what we're getting in the way of feedback from clients. You can also access a pretty diverse and varied opportunity set and underlying type of real estate assets. Many of the asset classes that you would traditionally associate with the REITs, particularly here in Australia, would be the traditional three of retail, office and industrial, all of which are incredibly tethered to the traditional business cycle. And when you have a look globally and offshore, and one reason for that correlation benefit, and indeed the lower correlation, I think in particular, is the fact that a number of the sectors that make up large parts of the investable universe globally are considered alternative. And a couple of those that are really interesting is seniors living and healthcare. And indeed the seniors living prospects have only strengthened over the last 18 months in particular. And that's a function of both demographics. You can't slow or hold back the grey tsunami, as my much older colleague with more grey hair is able to say and does often. And you can't bring online the amount of units in seniors living that's required for the ageing population given demographics and the projected population of people over the age of 80, in particular in North America and developed markets in Europe. So seniors living is an excellent asset class at the moment, benefiting from bottom-up supply-demand dynamics and, of course, top-down demographics. And those factors are completely untethered to the traditional business cycle and will continue unabated. And that's where we're seeing tremendous opportunity. There's also really interesting opportunities in residential, multifamily, single-family housing, the absolute essential service, shelter, tenant diversification, and an asset class that we can't really get access to here in Australia, and of course data centres, which are again benefiting from some pretty solid structural tailwinds, but again a need to be quite discerning for investors. I mentioned assisted living. These are just a couple of the charts that show the pretty profound opportunity set ahead of us. The population of those aged above or going to be above 80 is really quite interesting when you roll forward with the demographic profile, particularly in the US, which is this first chart. And the second is that if you were to assume a 90% occupancy rate, that's the amount of units that would need to be developed in the unfilled bar there. And the solid green bars is what's actually forecast to be delivered. So supply-demand imbalance allows us to invest into a sector that has the best prospects for rental tension that we see anywhere. And if you were to ask me what attributes lead to enduring REIT performance, putting aside the corporate and capital wrapper, it's the prospects for rental tension. Data centres, of course. Many of you have heard of the incredible and insane amounts of capital that the likes of Google, Meta, Amazon are spending on data centre builds, but also the chips that are going to go live in those data centres. And of course, the likes of NVIDIA are where they all emanate from. That's going to continue, and we're in an interesting spot here because we've got those forward order books priced in, visible, and we can see what NVIDIA is selling, and we know that when they come online, those chips will go live in a data centre, so we can now invest in data centres with a bit of confidence that there will be that supply-demand imbalance and favourability for the real estate assets over, I would say, probably the next 2 to 3 years. Thereafter, it becomes a bit of a question mark on whether that spend was well done, or whether those assets become, to an extent obsolete, which data centre assets have historically done with certainty. So you will have heard about the halo trade, hard assets, low risk of obsolescence. Data centres are probably one of the biggest obsolescence risk tied asset classes in our sector. So we've taken a relatively cautious approach to investing in data centres. We tend to limit our development exposure outside of select areas, so where we've got good visibility to that development being pre-committed or de-risked. But outside of that, it's in the likes of a name like Equinix, which are a global data centre network-based interconnection provider that already own the assets that are built and that are benefiting from the non-normalised demand now. But of course, there is a question mark on AI and its overall efficacy and, the benefits that'll accrue to corporate society and genuine productivity. And, my views have changed pretty rapidly, as I'm sure no doubt many of yous had in recent times, just by using, Copilot and Claude, which is exceptional and does the work of, a number of analysts, I would say. So that's really, really quite profound. I guess just wrapping things up, conscious of time, our expectations and outlook for the sector. Look, the macro has driven the bus for a long period of time, and unfortunately it seems like we're in a non-normal shock type period where that's going to be the case. But the fundamentals are shining through, and they can't be ignored anymore, because we've come through a period where supply-demand imbalance has been exacerbated by the difficulty to bring any new supply online, and the attributes of real estate as a real asset class to maintain and grow the purchasing power of capital off the back of indexation and fixed rent reviews is really quite solid. There's opportunity in the sector for active managers because of the mispricing. We can look at transaction evidence and see the implied transaction yields and cap rates in the listed market showing anywhere upwards of 20 to 30% discounts. We're also in a part of the market now where the value of high quality portfolios in resilient capital structures managed by some of the highest quality management teams out there, I think, shines to the fore. And the sector is definitely, in our view, mispriced, but, in plain sight for portfolio opportunities. So, look, with that, I might just pause and see if there's any Q&A.
Questions? Yeah, Paul? Yep.
So other managers... Thank you very much. Other managers have suggested that the obsolescence in relation to data centres actually resides with your Googles, your Amazons and the actual people using the data centre, not the data centre provider, which provides the energy, the air conditioning, the facility. To what extent do you look at data centres where the obsolescence risk isn't within them and therefore you can invest because the demand for what they do provide is beyond the capacity by many multiples?
Yeah, sure. Great question. Look, it's a really interesting point, and I've been investing in data centres probably for the last 12 years, indeed, since we had our very first and our own data centre REIT here in Australia, which was the Asia Pacific Data Centre Trust. It had 3 assets that were leased completely to NextDC. NextDC saw them as so important that they actually privatised the REIT themselves. I roll forward a few years to about 6 years ago when I was in London at a conference talking to the CEO of Digital Realty. And he was extremely happy with himself because he'd just sold a portfolio of tier 2 and 3 data centres to a Singapore REIT listed out of Singapore and owned by one of the Temasek entities, because he knew that they were going to be redundant in a few years' time, because they were only providing a handful of megawatts, 3 or 4 megawatts, the traditional data centre, leased to a telecoms provider, and low likelihood of being fit for purpose for the intense power usage of, say, back then a CPU. Now we've got a GPU where a data centre probably needs to have at least 40 to 50 megawatts. They're extremely costly at about, call it 20 million AUD per megawatt to develop. I've seen, even rolling further back, data centres delivered in the early 2000s that basically went through what industrial had always been, and that's a sawtooth return profile, where there'd be lease indexation and then an event at the end of the lease expiry and the need to relet, and the rents just fall off a cliff and you get that sawtooth type exposure. Now we're in a non-normal period where the megawatt rate is just through the roof, driven by AI. But there's still data centres out there that are struggling to find tenants. And there's a few in Singapore that were recently exited by the local telco up there, Singtel, and effectively they can't give them away because they don't provide the power connection or intensity that's required for new age chips. So power is essential. Data centre obsolescence, I believe, is a constant. And, to the extent that these GPUs that are required for AI applications need so much power to be, say, liquid cooled, if the data centre can't provide it, that's of the utmost importance. And look, who knows what happens with chip technology? I'm no silicon expert, but I'm a real estate person that looks at fundamentals of demand and supply, and, that's why we're taking a relatively risk-aware pick and shovel approach to our data centre exposure.
Another question for Mark. I guess my question sort of is a related one, which is, have you found it necessary to think about the future of particularly office, but to a lesser extent, retail and industrial, given the AI?
Yep.
Sort of given the potential of AI to remove jobs from the industrial West.
Yeah, it's a really interesting point, and the short answer is it's too early to tell. I mean, I can't help but use Copilot and Claude and think, gee, I could probably have a couple of agent analysts working for me independently in a couple of years' time, and I won't need to hire someone. That's one less chair, and of course, office space is the clear, loser out of that equation. That's probably the first order Armageddon effect. Our belief is very much that there will be a flight to quality. The highest quality office assets will still lease well. And that's what we're seeing, even in the most vacancy-afflicted markets. New York is a market that we're starting to see have, an order of magnitude more absorption that they had post-COVID. The amount of space being let's up 80% in that market. It's led by the highest quality buildings where, most of the vacancy is concentrated in a handful of buildings. So if you own the highest quality assets in office, they'll do well. That's our thesis. But I'm sure I can't help but think that CFOs and business strategists and planners will be asking, can the job be done by someone using AI to a greater extent and intensity before hiring someone? It's a bit uncertain and we don't know. If that's the case though, the office investment thesis will be the least of society and all of our worries, because every other asset class will be under pressure because no one will be buying anything at the store or paying their rent.
One other question from me. I just wanted to address the inflation question.
Yes.
We've heard quite a lot around geopolitical risk, multipolar worlds, all of that conversation, and maybe inflation is structurally higher going forward versus history. So how do you think about that in the context of G-REITs, and where does the valuation sit today in the context of history in a more inflationary environment?
Yeah, sure. That's a great question. When it comes to constructing portfolios for an investment market where growth is relatively low, inflation's relatively high, you want to be able to grow the top line earnings from your portfolio, so drill down into each individual REIT at a level that's better than inflation, or at least in line with it. So to that end, you want to be able to look at those portfolios that have a relatively shorter duration by construct of their sector and the ability to access market rents that are growing quicker than others. So long duration, long lease, long WALE assets, bad. Short duration, ability to access inflation immediately, think self-storage, think retail, very good. So probably won't surprise you that that's the kind of portfolio allocation that is getting a lot easier for our analysts to substantiate and our portfolio management colleagues to execute right now. Also capital structure. So gearing levels will be important. Access to interest rates on a nearer term basis, very important. So we're, unsurprisingly, the playbook is to allocate to those that have lower levels of gearing or lower levels of near term interest rate risk.
Thanks so much.
Thanks, guys. Have a good day.